So today Tesla stock fell down yet again, but what makes today's sell-off much more concerning is the fact that something I warned the Push and Profit private group a few months back in May has recently just occurred. And that is the fact that Fitch, a major credit rating agency, has recently downgraded the credit rating for the United States. Now this is a huge issue, and the way that I broke it down exclusively for the Push and Profit private group back in May was by oversimplifying it a bit, right? So just like you and I have a credit score, the United States government also has a score as well. And so recently they had a rating of, a triple A plus getting reduced to a double A plus. So this is like the equivalent of someone that had an 850 credit score, which is considered excellent, kind of getting, reduced down to a 735 score. Now, 735, it's still great. It's not terrible, but it's definitely a huge reduction from an 850 score. And so what would this mean for the United States government? Well, that means that borrowing could cost more, right? Just like if someone's score went down, right, and you go to finance a new car or any type of loan, you're buying a house, you're going to pay more in interest than someone who has a higher credit score because, of course, you're viewed as more risky, right? And so another issue that also comes along with this is that we may see a weakening of the US dollar. And of course, that's not good. But on top of that, the just confidence in investing in US treasuries may be a little bit shaky, and that could also slow down the economy, but also worsely, right? I think this is honestly the worst issue, is that we're gonna have to see the government basically, stop stimulating and kind of reduce spending, which is very hard for the United States government, by the way, but they're gonna have to do this at a time where we're already seeing slow economic growth. And so this actually kind of just emphasizes this, contraction, which can really just push the economy to actually slow down even further and, cause us to go into a recession. So, these are really big issues. And I know that, this video, we're talking about Tesla or Tesla stock in particularly, but we can't just look at Tesla and just kind of think about it as, okay, this is a company that sells cars. We have to have a multi-dimensional approach and be aware of all the surrounding data points that are happening. And so this is a huge concern. This is why when we take a look at Tesla stock in the aftermarkets, we saw that it sold off. Again, if we take a look at the overall market, we see that it sold off as well in the after hours. This is a huge issue. But on top of that, before the markets closed, we also had this news that Tesla is under investigation for Model 3 and Model Y steering wheels that freeze up. And so that's obviously just another concern for Tesla. So we kind of have this double whammy effect today where we just have individual concerns with Tesla, and then we also have, concerns with the macroeconomic environment. But with that being said, guys, I want to go ahead and just hop into my laptop and take a look at Tesla stock and kind of just dissect it both from the perspective of someone who is investing in Tesla in the long term and also someone who's trading Tesla in the short term as well. So let's go ahead and hop into my laptop. Alrighty, so we are officially in my laptop and we're taking a look at Tesla stock from a weekly time frame. Now, as I mentioned, I want to go ahead and provide my outlook on Tesla, both from the perspective of someone who is investing in Tesla in the long term, but also from the perspective of someone trading Tesla in the short term, as I often do in my videos, right? Now, I promise I'm going to go ahead and break down Tesla, in some of the technical aspects. Maybe I may touch on some things from a fundamental standpoint, but I kind of just want to, kind of bounce back to some of the things I mentioned earlier in the beginning of this video with the downgrades from the major credit agencies and provide a little bit more color as we kind of just have some more information that I wanted to cover with that. So, I want to highlight something that I thought was pretty interesting. So we had Janet Yellen, Secretary of the Treasury, recently add some commentary saying Fitch's decision does not change what Americans, investors, and people all around the world already know, that Treasury securities remain the world's preeminent safe and liquid asset, and that the American economy is fundamentally strong. Now, right here, I kind of just want to dissect this. So, first off, when you hear someone from the government saying, hey, this is not too bad, you shouldn't be worried, you actually should be worried, right? That's just some light or something I want to add on to there. But obviously, what I really want to comment on is what she says afterwards, right? So Ms. Yellen describes the change as arbitrary and noted that Fitch's rating model showed U.S. governance deteriorating from 2018 to 2020, but that it did not make changes to the U.S. rating until now. So basically, kind of just dissecting what she means over here is that, hey, the rating doesn't really matter because when things were looking bad in 2018 to 2020, they didn't downgrade us. So the fact that they're downgrading us now, well, hey, their rating and how they grade things really doesn't matter because they don't really grade things the best, because if they did, they would have downgraded us back then, right? So that's basically what she's saying. Now, I want to scroll up to a little bit, in the beginning of this article from the New York Times, where it says, at the margin, the move by Fitch could limit the number of investors able to buy U.S. government debt. Analysts have warned some investors are bound by constraints on quality of the debt they can buy, and those that are required a pristine credit rating across the three major agencies will now need to look elsewhere to fulfill investment mandates. So what she's saying right over here, kind of downplaying it, saying, oh, well, it doesn't matter, the way they grade things isn't really that accurate. Well, regardless on how accurate they are with them grading things, the reality is they did downgrade us today. And so what does this mean? Well, this means that some investors, like mutual funds or pension funds, are required by their investment mandates to only invest in securities with the highest credit ratings from all three major credit rating agencies. And so with Fitch downgrading the U.S. debt, well, those investors will no longer be able to buy U.S. treasuries because they no longer meet the required pristine credit ratings across all agencies. So what she's saying over here kind of doesn't even matter. The whole point that, hey, it's not accurate, it doesn't matter if they're accurate or not. The point is they went ahead and downgraded us, and that means that there's going to be less, money flowing in to buy this debt. We're going to have less creditors available to us, and that's a huge concern. And so that's why I go back to my point over here that, when you hear someone from the government saying, hey, it's not too much of a big deal, it kind of is a big deal, right? Anyways, I'm going to go ahead and leave it off there and kind of go back to the charts, right? So, bringing it back to Tesla stock, kind of steering away from geopolitical issues or just the macroeconomic climate that we're in, one of the things I've been saying is that, I'm bullish on Tesla in the long term, right? As a long-term investor, I'm bullish on Tesla, and I'm talking about the horizon of 2025 to 2030. Why? Well, I say it often that Tesla is still in the lead as far as the EV space goes, right? And so if we kind of just zoom in a little bit, the other day we saw Tesla rally up over here, and it was really because of the news that we had, or really what we heard from Ford's earnings, or in the forward guidance and also in their earnings, we saw that Ford was actually still losing more money than anticipated in the EV space. And then they also had to push back their targets on their EV production numbers, right? They said that by 2023, this was a year ago, they said that by 2023, they'd be able to produce 260,000 EVs. Now they're kind of saying, oh, well, it's kind of going to have to be 2024. So that's why we're still seeing dominance for Tesla in the EV space. And I think there's a lot more that Tesla has as far as benefits that I may touch on in this video, but I also want to kind of talk about Tesla from a short-term perspective as well. Now, I want to go ahead and highlight something. So one of the things I mentioned is that, from a technical perspective, we've seen Tesla stock kind of get rejected by this descending trend line, right? We see it happen a number of different times. We see 1, 2, 3, kind of like 4 around over here. It may be like 5 if you kind of, in reality, more than 3 times we've gotten rejected by this descending trend line. Now, on this channel, I often say that I don't put too much weight on technical analysis, as it's really just one data point. And I like to put much more weight on other types of analysis, like fundamental analysis, right? Because at the end of the day, a stock will move up and down because there's, money coming in and out. And why do investors put money into a company? Well, it's because they expect to have a return on their investment, right? And so, that's why I put much more weight on the fundamentals than the technicals, because at the end of the day, the stock market does not have to adhere to whatever squiggly lines you draw on the chart. But nonetheless, technical analysis is still a data point that we should be, watching. And the reason why I put a little bit more weight on that with Tesla is, as I pointed out in previous videos, Tesla has a very low holding from institutional investors. In fact, Tesla is invested by and traded by mostly retail investors. And what do retail investors and traders look at the most? They look at technical analysis. Why? Well, technical analysis is pretty much the easiest analysis you can learn, right? It's something that you could just pick up from some random guy on YouTube, or maybe just buy a quick book. It's one of the easiest analyses out there, right? Versus being able to understand, fundamental analysis, being able to understand PE ratios, price to book. We could go a little bit deeper in there, but trying to understand fundamental analysis is not that common with retail investors. Not saying that if you're watching this, you don't know how to do fundamental analysis. Just saying that it's not that common, and typically it requires a little bit more education or some type of learning than traditionally for technical analysis, right? Also, I put much more weight on economic data and catalyst events. Is a lot of the economic data is not something that's really walked through by a lot of retail traders, investors, right? One of the things that institutional investors and hedge funds and mutual funds and all these different funds look at is multiple different data points. They look at everything, right? They look at everything versus retail investors only looking at technical analysis. But guess what? Tesla is mostly held by retail. And so if they're pretty much looking at just this one data point, well, if something's showing that it's getting rejected with this data point that, Tesla, the majority of the traders and investors are watching, then most likely we could see a continuation of that pattern, right? And I hope I don't get too lost in that explanation, but from a short-term perspective, if you guys watched my last few videos, you could go ahead and do it. Probably for the last week or so, or pretty much after the earnings for Tesla, which was on the 19th, I've been kind of bearish on Tesla on the short term. Now, I know that may confuse individuals. They're like, how can you be bearish on Tesla but then bullish? Now, again, I want to clarify. When it comes to Tesla in the long term, investing, I'm bullish, right? But in the near term or the short term, it's very possible to be bearish, especially because I have a separate account, a separate brokerage account that's allocated to just trading and profiting off the fluctuation in price. And I know a lot of individuals get mad when I say I'm shorting Tesla. It's kind of like, oh my gosh, you're anti-American. Tesla is this American company and, you're shorting it. But at the end of the day, it's just really hedging my long-term portfolio where I'm bullish on Tesla. You can't just be a perma bear or a perma bull, right? You have to be a lot more agile and dynamic, and you can't just have this one approach. Now you can, right? But you have to understand that the market's very cyclical, and of course there's things that change back and forth, right? I mean, it happens all the time, not only in stocks, but even in real estate, right? And so you can't just be oblivious and think, well, if I'm bullish, that means I could only think of things going up. There's going to be times where things go down. And in the short term, I've been really bearish on Tesla in the short term. And, it's been pretty much working out as we see Tesla stock has been really falling down. Of course, we consolidated around this area, and right now we're actually still selling off. Now, as far as, consolidating around this area, I want to touch on that, right? So one of the things I talk about on the channel oftentimes is talking about the volume profile, which is volume relative to price, which is completely different from your traditional volume relative to time, right? So when we see there's a lot of volume relative to price, that means that there's a lot of trading going on, around this price level. So that means there's a lot of buying, there's a lot of selling. And guess what? When there's a lot of buying and there's a lot of selling, that's where we see consolidation. That's where we see supports and resistances, right? We see that if we kind of look at this area right around here where we have this red dotted line, which is the point of control, we see that that's where there's a lot of volume, and that's where we see a lot of, kind of sideways movement, as opposed to this area going upwards where we have very little volume by price, right? Because of course, when there's very little volume by price, that means that there's less of a battle between buying and selling. And so whichever direction the pressure is, if there's a lot of buying pressure, well, it's going to push up the order books. Vice versa, if there was selling pressure, it's going to push down the order books. Let's go to a weekly time frame and kind of just look at this, right? So we see over here, when we kind of zoom out, we see that there's a lot of volume by price around over here. Well, if you kind of go back, what do we see? The biggest amount of consolidation around this area. And where's the smallest amount of volume by price? What's around over here? Where do we see the biggest moves in Tesla, the biggest candles? Right around this area. And so, when we look at things from just a technical perspective, I don't try to discredit technical analysis. I think it definitely has its value. but really it's just only telling us historical price action. And what we see is that historically, looking at the charts, we see that there is a lot of volume by price around this area. And so one of the things that I'm pretty much been saying on all these videos is, if Tesla continues to fall down, not guaranteed that it's going to happen, but if it continues falling down, well, I want to watch it at around this, early $200 level, because that's going to be a level where obviously we've seen it be a support in the past and a resistance in the past as well. And so I want to see, does Tesla hold up around this area? Because if it touches this area and it bounces up, well, that's confirmation for me to deploy more capital into my long-term portfolio for Tesla, because it's confirmation that, hey, we sold off and now we're bouncing up, right? Warren Buffett has this, famous quote where it's pretty much just saying, be fearful when everyone's greedy and be greedy when everyone's fearful. So if Tesla stock falls down to these levels, not guaranteeing that's going to, but if it does, well, I'm going to be pretty much greedy, as everyone's going to be worried about Tesla at this area. But once we see that confirmation, I'm going to say, okay, well, now it's time to buy, right? When Tesla was running up, this was probably not the best time to add into Tesla, right? You can't be greedy at this area when everyone else is greedy, because we're closer to an area of decline, right? And so it's very basic when it comes to investing, right? It's just pretty much just buying things at a discount, finding that discrepancy between price and value. And so that's pretty much what I'm looking at with Tesla from my long-term perspective. Now, of course, does it have to touch this area? No, right? Stocks don't have to do anything that you think it could or want it to do, right? We could see Tesla stocks still break above this, descending trend line. That's not impossible, right? Stocks don't have to adhere to these squiggly lines we draw on the chart. But more than likely, what I've been saying in a lot of these previous videos, and like I said, you could go back and watch them, is that I'm bearish because right now, right, when you kind of factor in the fundamental perspective, the technical perspective, and then everything happening from an economic perspective, things are not looking good. In yesterday's video, I talked about how we want to pay attention to the data that's incoming right now, or for this week, which is a lot of the job data. Now, today we had the JOLTS report, right, the job openings, and we saw that job openings fell down, right? Now, real quickly, typically, when you have job openings falling down, that's bad, right? And when you have job openings, obviously growing, that's good, right? But the reason why we're kind of in this inverse situation is because we know that the Federal Reserve is hiking rates so that they could obviously stifle the economy, right? And one of the main issues for them has been the labor market. And so we kind of want to see the labor market cool off just a bit so that the Federal Reserve doesn't continue hiking rates, because we know that hiking rates has a devastating ripple effect into the economy and into the markets, because obviously it makes it more expensive for businesses to go ahead and borrow money, right? So obviously it's just much more difficult when we have higher rates. I mean, if we take a look at the S&P 500, pretty much after the pandemic, right, this is around 2020, when we went to a zero interest rate policy, we saw that the market was just rallying up. We had this essentially free money period, and then on top of that, we had the fiscal policy with trillions injected as well. But that's just a different story. But even before the pandemic, we pretty much had a long history, right? If we kind of go back before the Great Financial Crisis, which was in 2008, really 2009, started in 2006, but we won't go there. Basically, after this area was when we had the Federal Reserve kind of start this quantitative easing process, and we pretty much benefited from the market rallying up this entire time. Now, me personally, I didn't benefit from the market the entire time, as one thing that I often say or tell you guys is I didn't really get involved into the market until 2016, right? That's when I first started actually investing in the market and trading in the market as well, right? Because this was obviously when I was just in college and actually getting just anyways, you guys don't need to hear my backstory, but nonetheless, we benefited a tremendous amount. I didn't personally, because I got into the market in 2016, but for individuals who have been in the market longer than I have, well, we benefited from this easy monetary policy from the past, tremendous amount. And now we're seeing this inverse effect where obviously when rates are really high, well, it's going to have an inverse effect, and that's what we saw in 2022. Now, of course, in 2023, we've seen this massive rally in the market with this AI boom, right? But I'm kind of going off tangent and kind of I need to kind of go back to this labor market situation, right? So today, as I mentioned, we had the job reports. We saw that job openings decrease, which was good. That was actually good for the market. But the problem was, even though it beat expectations and kind of decreased, softly, right, by a little bit, at the end of the day, it was only by a minuscule amount. It wasn't anything crazy. And again, we don't want like a full-blown recession with too many people unemployed, but definitely a signal of just job openings closing and a little bit of softening in the labor market would be bullish for the market. Why? It's not that the market wants people to not have jobs, but the market's forward thinking and they understand, or the market understands, hey, if we see job data kind of cool off a bit, well, that means the Federal Reserve may, kind of just pause again, right, and kind of just leave rates at where they're at. Not saying that that's still good, because of course the economy still has to feel the impact of the previous rates that have been done, but at least we're getting a pause instead of another hike. And so we still have much more job data coming in. I've been pretty much updating the Push and Profit private group daily, as I often do, on the job data, right? Going into the end of the week, we had the unemployment rate, and then, of course, U.S. weekly hours, or hourly wages. So that's something that we're going to want to pay attention to. But definitely a lot of data that we definitely want to look into. And that's why, I often say when it comes to Tesla, a lot of the individuals that talk about Tesla on YouTube, they're kind of just reading into the headlines. And, that's fine, but the market's much more dynamic than we tend to give it credit for. And it's more important to really understand what's actually going on. We know that auto loans are extremely high, and that's a big issue for Tesla as well. And so that's another reason why I've been kind of bearish on Tesla in the short term. But to even add onto the fuel to the flame, as they say, we had this news of Tesla being investigated with some of its models. So that's just another issue. So that's why I'm going to be monitoring Tesla. I may have more opportunities to short, which is just really me hedging my long-term position in my long-term portfolio. But we'll go ahead and see. Of course, as I say, we want to stay data-driven and, be very agile with the data that's incoming and being able to update what's currently going on. So if you guys want those updates, those daily updates where I talk about what's currently going on, as well as my, trade ideas daily, then make sure to check out the links in the description below, because the first link is going to be a link for the Push and Profit private group, where you have access to my daily trade ideas. Every single day I talk about what's currently going on, so definitely take advantage of that. And also let me know in the comment section below, what are your thoughts on Tesla going forward, both in the short term and in the long term. I'm curious to know. I always like hearing your feedback. And with that being said, guys, hopefully you found some utility in this video, and I'll see you guys on this next video right over here. Take care, guys.